for Institute. Mr. Kale is a chartered accountant and a member of the ICA. He has given me a very short profile that he has over 16 years post qualification experience. He has been practicing in the area of transfer pricing and international taxation for past 13 years. He is a partner with PSR company and also worked in KPMG New York and Amsterdam office. And as I understand, he was also greatly involved in the API is something new that has happened in India in past 1 or 2 years. But he has very extensive experience because that is what we were discussing earlier while he was in UK. With this brief introduction, I place before you Mr. Kale. Before I request him to start with his presentation, may I request President Mr. Yatin Shah to offer a memento.
Very good morning to you, fellow members, ladies and gentlemen. In today's topic, financial transactions and intra-group reimbursements, we'll mainly focus on financial transactions, and the way we will have structured this presentation is that we will go through some of the basics of financial transactions. What is the difference in the concepts and benchmarking involved in financial transactions vis-a-vis other aspects of transfer pricing. We will deal with specifically with loans, guarantees, letters of comfort, some of the main controversies which are there in this area. I have tried to give as many case laws as possible in this presentation. The time may not permit us to really go through each of them. Again, by no means are the case laws that are given, they are not by any means exhaustive, but what I've tried to do is to include all the case laws which are relevant and which really lay down the main principles involved in this area. So let me first begin with what is really the difference when we talk about financial transactions. What is it that is different? And before that, broadly I will include three items in financial transactions. You would have loans, you would have guarantees, and you would have others. And when I say others, it could be derivatives, it could mean any kind of hybrid products where the benchmarking principles involved would be more complex. The main difference really is that as far as financial transactions are concerned, vis-a-vis other parts of transfer pricing, you will find that margin-based approaches are not possible. So typically your cost plus method, PLMS method will not apply. You will have to have some kind of a transactional level benchmark. So be it a comparable uncontrolled price method, or in a lot of cases what is now permitted under Rule 10AB, the other method would be used. The availability of comparable data is typically a big challenge. Sources of data are limited. When it comes to the bond market, India does not have a very developed bond market. So getting prices in relation to financial transactions is a challenge. Then the other issue that comes up is what is the point of reference. So when I say point of reference is, firstly, what is the time period you look at? As far as the rules are concerned, you need to take comparable data from the relevant previous year. But as far as financial transactions are concerned, there's so much volatility on a day-to-day basis that you may not, a transaction that happens in the morning may not be comparable to what happens in the evening. So again, it's very important how you define the reference data, from where do you pick up the data. Then geography can have a big role because different countries would have different economic conditions, inflation rates would be different, currencies would have an effect. The other aspect is that there is very limited guidance. If you look at either the OECD guidelines or in fact the rules, there is absolutely nothing given by way of any guidance in terms of how to benchmark financial transactions. So this leads to some degree of subjectivity, and we will come to what kind of subjectivity as we go along. Another thing is when you evaluate financial transactions, you need to look at who is the assessee. Is the assessee in the business of financial services, or is it a normal assessee who is engaging in some financial transactions intra-group? That will have an impact on the analysis. The other differentiator is the very high volumes. So especially if you're dealing with a bank, the volume of transactions is so huge that even a small variation can result in a huge transfer pricing adjustment. Having said that, the basic principles when it comes to transfer pricing remain the same. Ultimately, you have an international transaction, you have to compute the arm's length price. That principle remains the same. These are the requirements under Rule 10b2. It would apply in the same manner in a financial transaction, loan transaction, as it would somewhere else. So, various conditions, let's say characteristics. So when you look at the financial transaction, whether it's a loan, it's a debenture, what is the size of the loan, what is the tenor of the loan, these would be the characteristics that would be required for comparability. The functional analysis. Again, what is the, who is the lender, who is the borrower, what is their relationship? What is the lending for? Is it a parent company lending to a subsidiary for some business activity? Is it a parent company lending to a special purpose vehicle for making some further downstream investments? These would be important functional characteristics to determine a financial transactions analysis. Contractual terms, whether there is a security involved, whether there is what is the tenor of the loan, these would have naturally an impact. What are the economic circumstances? The time of when is the loan being given, the timing of the loan, which is the market where the loan is being given. These would be factors which would affect the comparability. Again, as in any other method, Rule 10b3 allows us to make adjustments for any differences between the comparable or the uncontrolled transaction and the international transaction. Adjustments can be made. Now, as we go along, we will see what are potential adjustments that are possible in this case. But I'll give you one example. Let's say there is an identical loan. All terms are identical, but the borrower is, let's say, one borrower is based in the US, the other borrower is based in India. If everything else is the same, the sovereign risk is different. So let's say US has a sovereign rating of AAA. India has a sovereign rating of BBB minus. That itself would mean that in an open market, the rate of interest would vary. So this is, and again, it's something for which an adjustment is possible, because you would be able to get data for what's a BBB rate, AAA rate, and a BBB minus rate, and that kind of adjustment is possible. Increasingly, we are seeing that there is a greater focus when it comes to financial transactions. Number of factors that are really leading to that. One of the main factors being the volatility involved. And over the last 10 years, we've seen so much of volatility in the international markets, right from the dot-com bust in 2000, 2001, right up to financial crisis in 2007, 2008, Euro crisis last year. So if you just see something like a Fed rate, which all of us would be aware of, if you look at the Fed rate in 2001, that's just before the recession started, the Fed rate was 5%. Thereafter, in 2008, at the time when Lehman Brothers collapsed, the Fed rate had come to 2%. And in general, as you are all aware, that developed economies, their monetary policies have been structured in a way to really combat the recession in those countries. And that has meant there has been an increasing low interest kind of a regime. Also, if you look at some of the geopolitical factors, so if you go back 1 year, the biggest concern was the breakup of the euro. Today that has somewhat receded. Big concern last year would have been Syria, today it would be Ukraine. But the point is that all these factors are resulting in a lot of volatility when it comes to financial markets. and this means that there is so the economic crisis, and which leads to a general tightening of credit, which means that companies have to do a lot more intercompany transactions for funding. There is a lot more guarantee related transactions that have to be given. Now, when it comes to the legislation, when it comes to different governments, obviously there is a shortage of revenue, so financial transactions are one area where they are going after and trying to make a lot of adjustments. And this is really few of the factors that have led to a significant increase in the focus on financial transactions in the past few years. Some of the key challenges that we are facing now in India is that loans, guarantees, letters of comfort, they're all being looked at, painted with the same brush, and they are generally seen to be soft targets. So if you look at the kind of adjustments which have been made over the last couple of assessment cycles, the biggest adjustments have been made in relation to share issues. In the recently completed assessment cycle, some very big adjustments have been made in derivative transactions. So again, it shows that it's a function of the subjectivity involved, and it's a function of the amounts involved, where a small variation can result in a big adjustment. And again, there has been a 2012, there was a new definition of capital financing which was introduced as part of the international transaction in explanation to section 92B, which has retrospective application and which has created some additional confusion, which again we will come back to. Couple of recent developments, safe harbor rules and advanced pricing agreements, which again we will deal with. Advanced pricing agreements is something which today is being looked at as a way to really reduce litigation for financial transactions, because you are able to demonstrate upfront. It's much more efficient to do that rather than trying to demonstrate it after 2 years after the transaction. So now we start with some of the basic principles when it comes to benchmarking of loans. So these are some basic steps involved in benchmarking any loan transaction. So step 1 is determining the creditworthiness of the borrower, making adjustments for any specific characteristics, determining the arm's length rate of interest, and further corroborating that with some market data. These are the broad steps which are followed in any interest rate benchmarking. So when we talk about creditworthiness, what we are seeking to do is establish a credit rating, a default credit rating for a particular borrower. So this is a rating scale which is used by S&P. So S&P, Moody's, Fitch, these are the 3 leading rating agencies, as you are all aware. And S&P and Moody's, these are. So the highest rating is AAA, and you go down to D. Triple B is, or rather triple B minus is what is investment grade. So anything above triple B minus is considered investment grade, anything below triple B minus is considered junk. Similar ratings are there in Moody's as well. Their terminology is different, but for every S&P rating there's a parallel Moody's rating. This is an example that, again, this is illustrative. Some of these, the numbers may not really tie up, but I just put it for illustrative purposes. This is a methodology which is again available publicly. It is known as the Damodaran model. If you just Google it as Damodaran model, it is available on, this is Professor Ashwath Damodaran on his website. This is a model which is freely available, and it is known to be a very good predictor when it comes to credit ratings. So in my experience in the US, where we have used licensed databases for doing credit rating and used to back it up with a Damodaran model. Many times the Damodaran model rating almost matched what was given by the licensed software. So what Damodaran model works on is primarily the interest cover ratio. EBIT divided by interest expense. That is the main ratio that it looks like. So if you look at this balance sheet, you have this company which has a loan of 200 at 12%. You got an interest here. The interest cover ratio is EBIT, which is 150 divided by interest 24. You have an interest cover ratio of 6.25. Now if you see the column on the right hand side, the table on the right hand side, this is the rating scale which is given in the Damodaran model. And again, there are different models for different types of companies. So be it an industrial company or a financial company, there would be different scales provided for that. So in this case, if you see interest cover ratio of 6.25, it gives you a rating of A+. So by applying this model for this particular borrower, you are able to establish that this borrower would have a rating of A+. And based on this, then you go on to determine what would be the rate of interest that a borrowing made by this borrower would attract. That would be the next stage. Before going into the next stage, it is also important to understand to do a stress testing of the balance sheet of the borrower to see what is the impact of the loan on the balance sheet of the borrower. So taking this example, on the left hand you have X Limited with the existing debt. So existing, we have a debt of 20, share capital 100, loan 20, total assets 120. On the right side, we are increasing that loan to 70. So we are saying that this company borrows an additional 50. Now let's see what is the impact on the different ratios. So debt equity ratio from 2 to 10, it increases to 7 to 10. And interest cover ratio, which is 5, it drops to 1.4. So in terms of rating, by introducing a debt of 50 into this company, your rating will drop from A to B minus. Now what is the implication of this? Is that because the rating is dropping from A to B minus, you could have a situation where this company may not be able to raise debt at that rating. So idea here is to see not only what the rating is, but also to check any additional debt that is introduced, what is going to be the impact of that debt on the rating, and whether at the lower rating the company will be in a position to raise money. So again, as I said, these numbers are not accurate. These are just given for illustrative purposes, just to bring out the concept.
Yeah, just like in profit and loss account, okay, you have not increased the revenues, let's say utilization of the fund. So because of the utilization of fund, maybe your EBT
Yes,
or so whether this type of adjustment we need to do.
No, so I tell you, in a real sense, what will happen is you will generally look at forecasts. You will not look at this number, you will look at forecast. So your point is absolutely well taken, that if you have introduced debt, that would have an effect on my forecast, and to that extent there should be an increase. But as I said, this is only to drive up the concept. That's why the revenue numbers have not been changed.
This off-balance sheet item, like suppose this company already issued guarantees,
Sure.
which is much larger than its net worth.
Yes.
That also will have an impact on.
It will. So again, depending on what model is being used, there is you need to factor the off-balance sheet items also.
If there is a huge guarantee obligation, then even Damodaran model itself will fail in the very first level.
So again, as I said, I've just given you a very simple illustration. Even the Damodaran model has a place to make adjustments for this. And again, so that's why even the Damodaran model is not used in isolation. You will look at other factors as I come to. I'll just come to it on the next slide. So this is again something which is publicly available. This is a rating methodology which is used by Moody's. So if you go to the Moody's website, you will find their rating methodology for again different classes of companies. So what I've given here is for financial companies. There are non-financial factors and financial factors, and they have given some guidance in terms of, so let's say, what is the market positioning, what is the diversification, what is the level of, what is the risk positioning of the company involved, what is the quality of assets. So there are various kinds of parameters given, and based on those parameters, there is you need to take a subjective decision in terms of what you would grade those parameters, and on an aggregate basis, then you will come up with some rating. Now this is inherently subjective, but then let's understand that the entire rating is a subjective science, because otherwise you wouldn't have had situations where AAA rated CDOs were basically junk. So it is a subjective exercise. Again, the department is now using a software called Risk Calc. This is the software which the department is using. But again, none of these models have really gone to court. So there aren't decisions which talk about which model is appropriate or what should or should not be used. So there is a good basis to even use things which are publicly available, like Damodaran's model or the Moody's methodology. Also, in addition to non-financial factors, there are these financial ratios, profitability, liquidity ratios, capital adequacy. These kind of ratios are prescribed, and the ultimate rating is a combination of these non-financial and financial factors. Moving on, now when it comes to benchmarking of the interest rate, these are some of the factors that are relevant. The tenure of the loan, security, size of the loan, currency involved, geographical factors, and typical sources for comparable data. So these are some of the databases which are used: Bloomberg, Thomson Reuters, Loan Connector. Again, a lot of the comparable data comes from the US market, because they have got the most developed bond market in the world, so most of the data will come from the US. Now this is some guidance which is available in the US 482 regulations. As I mentioned to you, OECD guidelines do not really talk about anything specific on interest rates. Our rules do not have anything specific, so this is some guidance that is available, and India chapter in UN has some comments which I will come to. So these are some factors which they have, US has listed down: the credit standing of the borrower, size of the loan, duration of the loan, currency, underlying security, guarantee, and the prevailing interest rate. The India chapter in the US UN practice manual, here India has said that the Indian administration is using sophisticated methodology for pricing of intercompany loans. This is what is stated in the UN practice manual, India specific chapter. So this gives a good indication of what positions India is going to take when it comes to interest rate benchmarking. So these are the factors that they have listed down: examination of loan agreement, comparison of terms and conditions of loan agreement, determination of credit ratings of both the lender and borrower, identification of comparable third-party loan agreements, and suitable adjustments to enhance comparability. Now, one of the things that India is doing is only to look at PLR-based rates of interest. So when it comes to outbound loans, Indian company giving a loan to overseas subsidiary, Indian tax authorities will look at what is the prevailing base rate of PLR, and based on that they will determine what is the rate of interest to be charged. And then they have also recognized that there are some challenges because of the unavailability of databases for doing this benchmarking. Now when it comes to guarantees, the India position is that they will look at the difference in the credit rating of the guarantor and the recipient of the guarantee. They will look at the difference in the credit rating and translate that in terms of spread by looking at the respective bond rates in India. So again, the principle is that they will look at the India specific rates. That is also reflected if you look at even the safe harbor guidelines, which again I'll come to, both insofar as the safe harbors for interest rate as well as guarantees are concerned, they are both stated in terms of Indian benchmarks. These are some of the practical issues. Again, quickly run through them. The availability of data is a challenge. Even using these databases like Bloomberg and Reuters, there's a challenge in terms of getting comparability, challenge in terms of doing adjustments. Then we could have the fact that now with GAR coming in, thin capitalization, which again I will come to what is thin capitalization. Basically, if there is excessive debt, a company has excessive debt relative to its equity, that would be reason for a recharacterization, and to that extent, deduction of interest could be denied. What is the appropriate rate of interest, whether it should be PLR or base rate, LIBOR, what it should be. Now, moving on to the concept of thin capitalization. So today, we don't have this concept under Indian transfer pricing. So basically what it means is that a company should not have debt which is excessive to the equity of the company. So what tax authorities would do in a thin capitalization is if they find that a company has excessive debt, then the interest associated with that excessive debt, they will deny a deduction for that interest. Now various countries follow different approaches. So they could have, some countries have a fixed ratio approach where they will prescribe a particular ratio of debt equity. So let's say 2:1 is the debt equity, then any interest in excess of that is disallowed. Certain countries would have a earnings-based approach. So the maximum amount of interest would be defined as a percentage of EBITDA. Some countries like UK have an arm's length approach where they say that companies should be able to demonstrate that their debt equity ratio is arm's length relevant to the industry that is being looked at. So again, as I mentioned, the concept of thin capitalization finds mention in chapter 10A when it comes to the general anti-avoidance rule, and one of the measures that the tax authority can do is to recharacterize debt into equity or equity into debt in case they find an impermissible avoidance arrangement. So practically what will happen is, even today, although we are not seeing it on the ground, there is a possibility, looking at the trend of adjustments and the approach of tax authorities, it is possible that they may invoke transfer pricing provisions themselves to try and disallow interest by way of thin capitalization. And the way they could do it is relying on the definition of transaction itself, which includes a arrangement or action in concert. Now moving on to the definition of capital financing. So as we all know, Finance Act 2012 has amended the definition of international transaction with retrospective effect, and explanation 1 to section 92B clause C reads as follows: capital financing, including any type of long-term or short-term borrowing, lending or guarantee, purchase or sale of marketable securities, or any type of advance, payments or deferred payment or receivable or any other debt arising during the course of business. So now most of these things were, in any case, there was no doubt that a lot of these things were always covered as international transactions. There was a debate on couple of issues over here which we will come to, but